Assalamu alaikum. This is the seventh video on translation of foreign affiliate financial statements. In this session, we will talk about the temporal method and then we will do an exercise. But in the beginning of this session, I would like to thank my son, Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories without which making these videos would not have been possible. I would like to thank Nabia Khan for helping me out in preparing these awesome slides. I would like to thank my wife Samina for her care, encouragement, and constant support, who allowed me to use time for her in making this video. We use temporal method for two reasons. First, the economy is hyperinflationary in the country where the subsidiary is located. And second, the functional currency is equal to US dollars if the parent company is from US. If the parent company is from Saudi Arabia, then the functional currency is equal to Saudi riyals. In the temporal method, the adjustments are recorded in the income statement, so we don't make any adjustments in the balance sheet. When converting monetary assets and liabilities such as cash, accounts receivable, accounts payable, anything that qualify as monetary asset and liabilities, translate at the current exchange rate. In case of assets and liabilities carried at historical cost, use the historical exchange rate. In case of translating assets and liabilities carried at current value, apply the current exchange rate. Revenues and expenses related to assets and liabilities are translated at historical rate. For example, in case of long-term assets, there is depreciation, which is an expense related to historical asset, therefore apply the historical rate. In case of translating other revenues and expenses, apply exchange rate on the date of transaction occurred or apply the average rate. This is done as the company may not be able to keep track of the transaction date, so the company applies average rate. Let us do an exercise now, and we are going to use the same information that was in the previous video. The only difference is that now we are going to use temporal method. On January 1, 2008, Trend 10 Systems, a US-based company, purchased a controlling interest in Grant Management Consultants located in Zurich, Switzerland. The acquisition was treated as a purchase transaction. The 2008 financial statements stated in Swiss francs are given below. We have the balance sheet, we have the income statement and retained earning statement. Convert or remeasure the financial statements of the foreign subsidiary using the temporal method and then prepare a schedule to verify the translation adjustment. Please remember that since all the adjustments are to be recorded in the income statement, that's why we will start with the balance sheet. For translating the monetary assets and liabilities, use current exchange rate, that is the rate on 31st of December. Any monetary asset like cash, accounts receivable, or accounts payable are monetary assets and liabilities. So we have the rate of 0.5321, and for accounts payable also 0.5321, and when we multiply we have 29,266 and we have 17,027. For translating non-monetary assets like property, plant and equipment, we will be using the historical rate, that is the rate on 1st of January 2008, that is 0.5987, and that is equal to 22,152. To translate paid in capital, use historical rate, or if the transaction takes place after the beginning of the year, use the subsequent date. In this exercise, we are assuming that the transaction occurred on 1st of January, so apply the historical rate. So we have 20,000 and the historical rate is 0.5987, and this is equal to 11,974. We make the total of the assets, and this is 51,480, and based upon this information we will be plugging in the value of the retained earning. We have the assets of 51,418 minus the accounts paid minus the liabilities 17,027, and the common stock 11,974 will give us 22,417. This number has some relevance and we will talk about it in a while. Next, we are going to verify these figures. Now, revenues and expenses are to be translated, and now the total will be 51,418. And we are going to verify these figures. Revenues and expenses are to be translated at the average rate, and the average rate is for revenue is 0.5654. This will be equal to 42,405. Regarding operating expenses, it includes depreciation of 3,000. So depreciation will be translated at historical rate as it is related to property, plant and equipment. So 3,000 times 5987, that is 1,796. Other operating expenses will be now 27,000 and they will be translated at the average rate, that is 0.5654, and this will be 15,266. Now, if you calculate the net income, this will be total revenue minus the expenses, that will be 25,343. Now, this number has some relevance, and this is not actually net income. This is the preliminary income as the income before adjustment. Let us now translate the retained earning, and the retained earning will be, the beginning retained earning will be translated at historical rate at the rate on 1st of January, that is 0.5987. So this will be 5,987. Dividend will be translated at dividend declaration and payment day rate of 0.581, that is 8,715, and the ending retained earning, dividend will be net income is 25,343. Retained earning is at the rate of beginning retained earning will be at the rate of 0.5987, 5,987. And then we have the dividend, and dividend is at the rate of 0.581. So this is equal to 8,750. Now net income plus retained earning will be equal to 31,330, and from this we will subtract the dividend, and this will be 22,615. Next, you see, I told you that this is not income, this is a preliminary net income, and we have to figure out the net income. Now we have the beginning retained earning of 5,987. To this we are going to add the net income. We do not know the net income right now. And we will subtract the dividend of 8,715, and this will give us a ending retained earning of how much was this? 22,417. So if we substitute these values, we will get the net income, and the net income will be equal to 25,145. Now if you compare this net income with the preliminary net income, it is more. The preliminary net income is more, and this is more by 198. So this we are going to reduce the preliminary net income by 198. The difference between the preliminary net income and the income we have just now calculated, that is 198. So this is a loss, and this will be subtracted, and when we are going to subtract this value, our retained earning will be simplified, and this will be not 22,615 now, this will be 22,417. We have to make all the adjustments, and you can calculate. So in order to make adjustments while using the temporal method, we have used the backward method to get the net income. We started with the balance sheet, and then we prepared the income statement and made the adjustments over there. We started with the ending retained earnings, and to that we have to subtract the dividend. Ending retained earning, we added the dividends, and we subtracted the beginning retained earning to get the net income. Then we compare the net income calculated with the preliminary net income. If net income is less, then we will subtract, as we have done over here, by 198 from the preliminary net income, and record the difference as a loss, or vice versa. So we have done the adjustment using the retained earnings. Yet another way to find the adjustment is to find the difference between the net monetary liability position, the difference between the beginning and the year end of the year end difference between the assets and the liabilities, and let us see how we do that. Now the difference in beginning net monetary position, you see we have the net monetary position, that is total assets, total monetary assets minus total monetary liabilities is minus 10,000, and this difference is negative 10,000, and the ending net monetary position is 55,000 minus 32. That gives us 23,000. Let us now reconcile the difference between the two. We will first convert the net monetary liability position at the beginning of the year, and for that we will use the historical rate, that is the rate on 1st of January 2008, that is 0.5987. And this will be minus, because the difference is negative, 5,987. Next, let us make adjustments for changes in net monetary position. First, we will translate increase in cash and receivables from sales, and we are going to apply the average rate, that is 0.5654. So we have the sales of 75 times 0.5654. This will be equal to 42,405. Next, translate decrease in net asset position, and there will be decrease because of two reasons. First of all, we have other operating expenses of 27,000. We will not include depreciation as it is not a monetary expense. It do not affect cash. And the second will be the dividend. So for the other operating expenses, 27,000 times the average rate, that is 0.5654. This is equal to 15,266. And the dividend of 15,000, we will use the dividend declaration and payment date rate of 0.581, and that is 8,715. Now don't forget that these two accounts are going to be subtracted. And next, we make the total. If you make the total of these four, this will be equal to 12,437. Next, convert the net monetary asset position on 31st of December. On 31st of December, it is 23,000. We will use the current exchange rate of 0.5321. This will be equal to 12,238, and the difference is of 199. Now there is a difference of, here we have a difference of 198, and here we have of 199. This difference is because of rounding of the figures, so don't worry for that. So it can be seen that the net monetary asset position on 31st December is 199. So this is a transaction loss, and we have verified our calculations. So this finally, I would like to look at the difference between the current method and the temporal method. The only difference, you see, we are using monetary assets and liabilities, and we are using non-monetary assets and liabilities in our calculations. The only difference that you can see that for the current rate, obviously we are using the current rates, but for temporal method, for non-monetary assets, we are using the historical rates, and for non-monetary liabilities, we are using the historical rates. So this completes the first part of our explanation on translation of foreign affiliate financial statements using temporal method. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Happy learning.